Hey folks, good evening. Welcome to another money space with me, Kalu Aja. Of course, on our space, we're talking money, the economy, and finance, right? Personal finance. We're here 7 p.m. West African time every single weekend. And our job is to bring those topics that are important to you in those realms to you in a way that is easy to understand, easy to digest, so you can be a user and an implementer of what you hear to make your investment journey better. That's our role here, right? So, first of all, guys, I just give a shout out to our sponsor of this particular space. It's going to be Bamboo, guys. If you're not using Bamboo, that's your app that you can download on your phone, Nigeria, Ghana, South Africa, literally anywhere you are that you have a smartphone, you can able to get the Bamboo app. And what it does for you guys is that it allows you to invest not just in Nigerian stocks, but also in the US market as well. Like I always say, when I started out investing, we did not have the ability to invest outside Nigeria or even online on our phone. But the bulk of Nigerians today have a cell phone, you've got data on your cell phone, you can fund a wallet in Naira, and you can buy US stocks from your phone in Nigeria. So literally you have no excuse, right, on why you are not just investing, but diversified away from having just one investment in one currency or in one jurisdiction or even in one asset class. Your job is really to diversify, spread out that risk, right? So that you're able to reap the benefits of a falling, rising dollar and all that. You have to diversify, guys. So today we're talking about a strategy, right, that we call dogs of the Dow. I'm going to explain it. Dow just means the Dow Jones Index. You can change the Dow to whatever you like. It can be dogs of the NGX, it can be dogs of the South African Exchange, whatever you want to call it, right? It just simply means an index. What's an index? A collection of stocks on a particular, say, market or collection of, should we say, asset classes, right? So in this instance, is the S&P, the Dow Jones Industrial, which is the top 30 stocks by market cap in the US, United States, right? So you can change that Dow to whatever you want to do, and it will still serve that same purpose, right? So dogs of the Dow. Again, if you're watching, we are going to be on YouTube, and we're also going to be on Twitter. I'm going to try to share just the slides on Twitter. YouTube is up and running, so you can see the visuals. I've got great visuals, guys. So if you want to hop onto the YouTube link, I did share that YouTube link just the last post, I think, before. That way you are able to follow. You can still listen here and just look at the visuals on YouTube. It's fantastic. I also share it as well here as we get along. Fantastic, guys. And again, I'll just do 15 minutes, then bring your questions, and of course we can take your questions and we can learn together, right? So let's move on and go into our slides for today. Hi YouTube folks, thanks for being here. Appreciate you guys. You're always here with your great questions every week. Yeah, keep on being there, right? All right, so of course, just a quick disclaimer, right? So everything we're doing today is all educational, right? So we're not talking investment advice. I'm not your investment advisor. The whole idea is to educate you, to make you a better guy. Like I said, past performance is not an indicator of your results. This is not an offer to buy or sell any securities. It's just to educate you on what you can do to improve your investment outcomes, right? Fantastic. So that's done. Let's keep on going. So again, like I said, we talked about Bamboo as sponsors. Just want to emphasize that point again. You can sign up with your app in minutes. You can buy Nigerian stocks. You can buy US stocks. There's no paperwork involved. And it's perfect for the diaspora guys. Lots of guys send me DMs. I'm in diaspora. I want to buy stocks. They recommend a stockbroker to me. You don't have to go to a stockbroker, right? All you need to do is just on your phone in Houston, download the app, open an account, fund your account in US dollars, and you can buy Nigerian stocks. You can buy US stocks from Houston, right? And the key thing I like the app for is you can buy fractional shares. So let's say you're a young guy in Kogi State, right? You're just maybe a student. You don't have all that money, right, to invest. You have maybe 500 to invest. You can buy fractions of a share. So you don't have to basically get $400 before you buy a share. You can buy a fraction. You can start early. You can auto dividend. Like you can do a DRIP, dividend reinvestment program, on your app. So that way you can start this journey. You don't have to wait, right, till you use money before you invest. Time is the key asset that a young person has. So don't wait till you have money before you start to invest. Don't wait till you have a job. Trying to be not trying to be absolute here, but if you have cash that maybe someone gives to you, you don't have to spend it. You can open this app, buy something, buy an ETF that invests in the equity market. If you don't know what to buy, put something aside, let it work for you in time. Don't wait and say, oh, like when I get $1 million, then I'll start to invest. You're killing your advantage, which is time. Equities work best with time, right? So just making that point out there again, why you gotta use those apps that are out there. And like I said, I recommend Bamboo for you, right? So let's get straight into it. Like again, this chat, I always share this chat. All of us on this space, all of us here on this space, right? We're going to earn money, hopefully, and we're going to all spend money, right? That's not a problem. Nigerians know how to earn money, and Nigerians know how to spend money, right? So if you don't earn enough, your issue is you've got to go out and earn. You shouldn't be talking about investing if you don't earn enough money, right? So you have to earn something. The issue Nigerians really have a problem, and when I mean Nigerians, and I just emphasize, really everyone that I've spoken to, US, folks out there, the one issue they have a problem with is how to invest, where to invest, how should I do it? I have money, I want to invest. How should I start today? How should I track my investment? People have money, but they don't know how, the step by step on how to invest. That's the problem. If you don't know how to invest, then of course you can't take advantage of compounding. You can say, oh, this guy bought Tesla, I'm going to go buy Tesla. You're not sure why he bought Tesla. If you want dividends, you shouldn't be buying Tesla. But no one's going to tell you this, right? So you've got to know how to invest. And a good way to know how to invest is to try to follow fundamentals. There's always a blueprint that you can follow. If it aligns with your objectives, then that's going to be the way you want to invest. You just can't follow blindly. So what we try to do every week that we're here is to talk about the investing side. How do you do that investing side? How do you take the earnings that you've made to then invest so that over time the compounding advantages build up in your favor? That's what we're doing here this week, right? So I always put this chart up to explain to you. We are all going to earn, we're all going to spend. The problem is saving that money. That's the hard part. Saving money and not investing, and not blowing that money and then investing. If you save alone, you won't get wealthy. If you invest alone, you just do one investment a day, it's not going to work for you. You've got to invest over time. And when you compound, that's the wealth that you generate. It's not going to be a one-time dig, you go in, you come out. It's got to be something that is really, you fine-tune it, and it's part of what you do. Once you earn, you save, you invest. You earn, you save, you invest. You don't earn, spend, and then invest. You earn, you save, you spend, you invest, right? You earn, you save, you spend, you invest. That's the preferred part. You don't earn, spend, save, and invest. Put savings, pay yourself first. Put it first before you even spend, right, guys? So that's the key for us. And I hope you guys are following the slides on YouTube, and I hope you're following the slides as well on Twitter as well. So let's get straight into it, right, about this DAO business, this Dogs of the DAO business, right? So why do we like this Dogs of the DAO? Why am I talking about it today? It's a very, very simple process. Sometimes when we tell people we have an investment strategy for them, it's kind of difficult. You have to do this, you have to do that, you have to calculate this and calculate that. With the DAO strategy, it's very, very simple to do, right? It's very, very also easy to implement. And again, even if you are wrong, you are generating income. So it's not those strategies whereby if you do it and you are wrong, then you've lost money. In this instance, when we do Dogs of the DAO strategy, even if you are wrong, you are going to generate income whilst you wait. So assuming you follow this strategy, right, and you didn't work out for you, you are still going to make income. That's the one guarantee for you with this strategy. You're going to make income from it. What are the bad parts? Because I have to give you the goods and the bad. The bad part about the dogs with a Dow strategy is that when the market is booming, in a bull market, it's really booming, the dogs with a Dow can restrict you because you're not going to be buying those booming stocks. You're either going for income stocks. That's one thing that you have to watch out for, right? And again, not all dogs are good. We're going to explain what dogs mean in the stock market. Not all dogs are good, right? So because the stock price is low doesn't mean it's a good buy, right? And then of course, because it's an annual strategy, you might have to sell, and that brings commission and tax implications to your portfolio. So that's the bad part. But the good part, like I said, is very, very simple. It's very, very easy to implement, and it generates income for you whilst you are waiting. So who doesn't like simplicity and income? No one, right? So let's get into it. Let's explain what this whole thing means. We're not going to take your time, guys. So let's get into it. When we say that a stock is a dog, that means that the market is selling down that stock. The stock is not in favor, right? So when we say a stock has gone from $100, it's now like maybe $40. Well, that stock is like a dog, right? It's gone. It's not like a cash cow. You see that? You see those names, cash cow. The cash cow is the stock that's giving you lots of income, right? But the dog is that stock that was high. Now the stock price has come down, sort of, if you get my meaning. So when we say dogs of the Dow, we are trying to look for stocks that have gone down in price. Why are we looking for stocks that have gone down in price and still pay dividends? And why is it the Dow? Number one, when we focus on the Dow, we are only buying blue chips. So we're not just buying any stock in the market out there. We are only buying blue chip stocks. So the Dow is the top 30 stocks by market cap. In Nigeria, that would be the NGX 30. So Nigeria has the NGX, which is the index for all the stocks in Nigeria. But the Dow is going to be your top 30 stocks. So it will be NGX 30, or in this case, the Dow Jones, right? Which is your top 30. S&P is 500. Dow is going to be your top 30. So number one, we are only buying the top 30 stocks, number one. Number two, we are then buying those stocks when the price, look at the chart I'm sharing with you online. If you're on Twitter, the chart makes more sense if you look at what I'm sharing. When the stock price is at 100, and it's paying you a dividend, the stock has got to pay a dividend. So the stock price is $100, is paying you a dividend of $4, right? Your yield is going to be 4. Yield is the dividend over the price, so it's going to be 4, right? So if you divide 4 by 100, you're getting 4%. Now what happens, maybe this is in January, right? Then look at December. In December, the stock price went down to 60, but the dividend was still 4. So the dividend didn't go down, dividend was still 4. So what happened to the yield? The yield went up. You see that? Because why did the yield go up? Because the denominator, changed. So the 4 hasn't changed. But it's now 4 over 60 instead of 4 over 100. So your yield has gone up. Because the yield has gone up, the price has come down. So what are we looking for here? We're looking for a very, very good stock because it's just the Dow 30. So a very, very good stock that the price has come down. If the price has come down, we are perceiving a discounted good stock, but that is paying us a dividend, right? So remember, if I'm doing my Dow, my dogs of the Dow for 2026, I'm looking at 2025 figures. So in 2025 January, there were stocks in the Dow 30 that, for instance, were priced at $100, right? And those stocks paid a dividend of $4, which meant their yield was 4%. Now, in December 2025, those same stocks had seen their price come down from, say, 100 to 60, but they still paid that dividend. So you see, their dividends for 2024 and 2025 was either the same or rising. So you see the other good part. Number one, we've got a good stock at the falling price. Number two, we've got a good stock at the falling price that the dividend is either the same or rising. So it's still at $4, right? So the yield has now gone up to 6.7%. That goes into our Dow, Dr. the Dow list that we're going to look at because we are interested in buying a good stock that is paying a dividend that is the same or rising. This is a good, simple way for you to analyze stocks and buy. Good, simple way. We're not buying all stocks that have gone down in price, because some stocks have gone down in price simply because they are not good enough. We are buying good stocks, blue chip stocks that have gone down in price but are still paying you the same dividend. That's what we're looking for. So the dividend has not changed, has gone the same or higher. The price has gone down, which is a discount to us. So the yield has gone up, hence it goes to our Dr. Dow list. So high yield is not just the price. We're not just buying stocks that the price has gone down. We want to ask ourselves the question, why has that stock gone down? So we're not blindly buying. We also want to ask ourselves why the stock has gone down. So let's now look at, so the first thing that we've now understood, that when the yield is up, it's an opportunity because we're buying a good stock, right, at a lower price. And we're also buying that good stock at a lower price with the same or more dividends. You get it? Same or more dividend. Let's look at the next slide. Again, try to follow the visuals because it really just brings it home for you. We want to always ask why the stock price is going down. We're not just blindly buying the stock price. So let's what we call safe dividend yield. So we understand that dividend yield is when the price, right, has gone down, but dividend has stayed the same. Many stocks, their prices go down and their dividends stay the same. But which ones, how do we know which is a good, safe one to buy? I've given you a checklist here, right? So you want to look, this is some work you will do, right? Look at the dividend coverage ratio. It should be high. Dividend coverage simply means that the company's payout, that the company's revenues can pay the dividends. So the company is not borrowing money to pay that dividend that's going up. So the company is still making sales, right? Just keep it simple. The company is still making sales to be able to afford that dividend. Number two, look at the earnings of that company. We don't want to buy a stock that the price is going down and their earnings are going down. Why? Because if earnings are going down, that's a red flag for us. We want to see a company whose earnings are still going up and who's making enough earnings and sales to pay the dividends. Number three, we want to look at the dividend history. And most of this stuff, just ask your ChatGPT, ask your Grok, it will tell you. Is the dividend history of X and Y stock going up or down? Is the dividend history safe for 10 years? What's the dividend coverage ratio? To tell you all this stuff in 2 seconds. Number three, dividend history. We want to see 10 years of payments. So in Nigeria, for instance, the PFAs, the pension fund admins, will only buy stocks that have paid the dividend for 3 out of 5 years, right? So if you just look at the pension index, that's like a good way of saying, okay, these stocks in the pension index, if their price has gone down, those are potential Dow or NGX 30 dogs that you want to buy. So dividend history, have they been paying dividends for 10 years or more? Not just to come 1 year, pay dividends and then run away. No, for 10 years or more. Look at the debt level. Is it reasonable? Is it safe? So they're not borrowing money to pay you a dividend. Then look at the free cash flow. Is it strong and is it growing? The point, if you look at where we're going to with this checklist, is that we want to see companies making organic revenues. So they are making organic revenues and they're using those revenues to then pay you a dividend. Go back to our first slide. We said the yield has got to go up. Why is the yield had to go up? Because the price has gone down. And we said number two, the dividend has got to be the same or increasing. That gives us a very, very fundamental and disciplined way to approach buying a stock. So we're looking for number one, a good stock. What is good in quotes is an NGX 30 or is a Dow 30. So it's a blue chip, quote unquote, it's a good stock, right? Blue chip. Number two, we want in that blue chip universe a discount. So we want to buy a stock that the price is going down. But we want to also eat our cake and have it. We want to buy a stock where the price is going down, but the dividends are the same or rising. That's a dog of the Dow. And that's what we're showing here, right? So now we've seen what is safe. Safe means that the company is making organic revenues to be able to pay you that dividend. So what next do we do? Let's give you examples of what we're talking about, because this is all theory. Let's try to talk about specific stocks that we think are meeting this. Let's look at Verizon. Verizon is one of the dogs of the Dow for 2026. Yeah. So look at what Verizon is doing. Verizon's dividend yield was 6.5%. So it was higher than what it was in 2025. The payout ratio about 55. So that means maybe they made a return of $100. They paid out to their shareholders about 55%. Cash flow strong and growing. Dividend history 18 years of increase, 18 plus years of increase. So if you look at Verizon, they are making returns, right? They are making organic returns. Verizon is like your MTN and all that. They do cell phone service and all that data in America, right? So Verizon is making a lot of revenues. They are paying these revenues out as dividends, and the payout ratio and the dividend history are all positive. So for 18 years, they've been paying. So, and Verizon is in the Dow 30. So what we're doing is that we're buying Verizon at a discount on its price, because the price has gone down. So we're getting on Verizon at a discount, but we are also going to enjoy the dividend that Verizon is going to pay, because Verizon is not going to reduce its dividend, just the price has gone down, right? Look at the example of a risky example, what you should not do. Right now, we have a war in the Middle East, right? So you see lots of energy companies are going to make a lot of money because they're going to sell crude oil, gas, at a lot of returns. Now, if you see those small oil companies, they're going to make a ton of money because they're going to buy oil, maybe run it through the Hormuz and sell. So they're going to make tons of money. They're going to pay you dividends of maybe 50%, 60%. Shipping companies are going to make a ton. That's good. But that's not organic revenues. It's revenues that is driven by an event. So even if there's peace tomorrow, those revenues disappear by next year, right? So the payout ratio is going to be 90%. Earnings is going to be rising or falling. Dividend risk, it can be caught. So it's not just to look for a company with a high yield paying a high dividend. That won't qualify. It's got to be a company in the Dow that has always been paying and it's just come down in price, which is a discount to us, right? That's what we are looking for. And we can give you more examples, right? If you look at the US market, this is our list of the Dows that we have this year. Again, we're going with the Dow for May 2026. Someone's asking, do I have to sell every year? The day you start is your 1 year, right? So look at it this way. Why we say annual is because the companies pay full dividends for the year, correct? So if a company is paying you dividends for December, that means that's when you're going to more or less start your calendar. But if you are buying today, these are the Dows as at May 2026. You can see the companies are there: Verizon, Chevron, Nike, Merck, they make drugs, Amgen drugs, Procter & Gamble, Home Depot, IBM, McDonald's, and Coca-Cola. So all these stocks, right, are what they represent are Dow Jones 30 stocks, top 30 stocks in America by market cap, right? They represent that, and those are stocks that their price has come down. If their price has come down, their yield has gone up. If their yield has gone up, they're now potentially in your Dow column. And again, their dividend yield has stayed the same. And we have that verdict for you. So we took those indices we used for the safety of the dividends. Is the dividend safe? Is it going to continue? Is it organic? So you can see Verizon very safe. You can see Nike. Nike is, is shaky because that company has shrunk, right? So which is a bit moderate on that for Nike. Nike is come down. The market has actually come down for Nike. Procter & Gamble, very safe. McDonald's, everybody in America eats burgers, very safe. Coca-Cola, very safe. So again, look at what we're teaching here. The discipline to look at a company and say, I want to buy this company at a discount, and I want to buy this company. I also want to earn returns from this company. So I'm not just buying the company, I want to earn a return. Like I said, if you do this strategy, it doesn't work for you, well, you're still going to make a dividend income from the company. But if you don't do this and you buy some other stock, You might make money, you might lose money, you might not make the dividend. So that means, again, this might not be good for the guy that wants to just trade. If you're a trader guy, this is not your strategy, right? This looks like a strategy that someone that wants to, you are maybe getting older, you want to take less risk, or you want to grow your income. The dogs or the Dow is a good strategy for you because you can simply buy great companies that pay you a dividend. You start to build out that dividend portfolio in your balance sheet. So if you're like a trader, you're a younger guy, you want to just make money today and sell tomorrow, this might not work for you. But it's going to work for a guy that essentially wants to build that portfolio, and you have to sell every year. The Dow strategy says, yes, you sell every year because you want to go buy the next cheap stock. But if you just hold this portfolio, you're making some good dividends here. If I just say, okay, I'm not going to buy the whole Dow 10, I want to have my own, right? And I want to basically buy just Verizon. Again, I've taken a disciplined approach to buying Verizon. I'm saying I'm buying Verizon when the price has gone down and the yield is still stable. That's my fundamental strategy to buy this, right? So guys, I'm going to be done with this very, very soon. And if you have a question, just request to speak, ask on the YouTube, ask on Twitter, and I'll see it, right? We're almost there, guys. So again, I give you guys just more examples. What I've done here is I've taken the Verizon, I've compared it with the payouts. The same thing I've done, but just more information for you, right? So what I'm going to do next is try to show you the Nigerian version because I can't leave my Nigerian folks out. Let me show you the Nigerian version of the dogs or the Dow. Again, it's very hard to get the information for Nigeria because we don't track. We don't give we don't track the dogs or the Dow strategy in Nigeria per se. We have yield, we have returns, we have all that, but not specific the way the US has it. US actually has websites that track all this strategy and will give you every year this new strategy. But be that as it may, we did come up with our top 10 Nigerian NGX companies, safe dividend yield. So the exact same thing we did. We looked at Nigerian companies. We said, okay, since we're doing Dow, we're going to do the NGX 30, which is our version of the Dow. So the NGX 30 is your top 30 capitalized stocks in Nigeria. So we got those guys. Then we said, which ones have got the highest dividend yield? Because again, why? We're looking for the ones that their prices have gone down. Remember what we said, when the price goes down, the dividend yield goes up. Why? Because the dividend is the same, but the price has changed. Then we have our list of stocks right here. Then we also try to put the safe verdicts. This is on the dividend, not on the company, on the dividend. So you can see very safe, very safe. We put that out there. So who is on our list for the Nigerian side? We have Access Bank. Access Bank, highest dividend yield in Nigeria, about 10.59, very high. Access Bank is a bank. They've got tons of cash. Payout ratio about 65%. Verdict on their dividend payout, very safe. So Access Bank is going to be on your list. Fidelity Bank, second highest dividend paying stock in Nigeria. You've got GT, you've got Zenith, UBA, Stanbic, you've got Dangote Cement, you've got Seplat, you've got BUA, you've got MTN Nigeria. These are your universe. If you're trying to rebuild the dogs of the Dow for the top 30 stocks in Nigeria, this is what you would get. Again, let's go back. This is going to be for an investor that wants dividend or income strategy. You want to have good quality stocks, blue chip stocks that pay you dividends. That's going to be a good strategy for you. About 2 or 3 spaces ago, we talked about mutual funds, and we said when you buy the blue chip mutual funds, maybe you go buy the VOO, which is an American equity ETF that tracks the top 500 stocks in America. If you buy those ETFs, right, what you are getting is consistent, stable growth. You're not going to get the 2,000% growth. You're going to get your consistent, stable growth. Same in Nigeria. If you compare NGX 30 with the whole market minus NGX 30, the market minus NGX 30 moves faster than the NGX 30. I'll give you an example. Presco, Better Glass, NCR, those are the top performing stocks in 2025 in terms of performance of market return. Presco, Better Glass, NCR. NCR was the best performing stock in Nigeria in 2025. Those companies did nearly 1,000%. NCR did about 1,400% last year, 1,400%. But NCR is not a NGX 30 stock, it's not in that stock. So when you buy NCR, you're going to get, or a company like NGR, you're going to go to the moon. But what happens when the market starts to shake? Which are the first stocks to fall? The smaller cap stocks are the first to go down. So smaller caps take you to the moon, but they don't have any parachute. They're just going to come right down. Your blue chip stocks are going slowly, like a trailer going to Kano. They are going slowly on the road, 100 kilometers per hour. They might take 2 days, but they're going to get there. Your NGX, your stocks that are not on the NGX 30 are like a sports car. They will go very fast, but they have to stop to buy gas, if you get my analogy. So be careful, be clear on why you are buying stocks. Are you looking for growth, or are you looking for appreciation? Are you looking for income, or are you looking for conservative holdings? If you are looking for fast income growth, this might not be a strategy for you guys again. If you are older, you want to build a portfolio. Maybe even you're a retiree, you want to build a portfolio. Say, I want to buy blue chip stocks. I want to get stocks, but I also want income. I don't want to trade. I want to own stocks that will pay me income, but I want the discipline way to do them. Then this is for you, right? Hope to make that point. So this is your NGX 30 for Nigeria, and also your NGX 30 for. And like I said, you can create this with any index. You go to South Africa, do the exact same thing. Number one, you go to your dividend yield. Number two, you list them top 10. That's it. Like I said, it's very simple and very, very easy to implement. You don't really have to do much calculation. Most of this stuff, if you ask your Grok or your ChatGPT, it'll do them for you. Note the tickers. Tickers are how the stocks are traded on the stock market. The tickers. Like I said, we're going to go into how you want to do it operationally. This is going to be my last slides, guys, and you can ask your questions. How you want to do this stuff operationally, right? So so again, just to make that point again, why are we doing this dogs of the Dow? Why are we bringing it up and all that? Because if you look at the dogs of the Dow strategy, it has beaten the return on the Dow Jones. At least beat it last year, clearly beat it last year. And if you look at over a 10-year return, it's also beaten it, or it's also been equal, right? About 9.8 to 9.5. That's the return. So it's not like you're going to do this dogs of the Dow strategy and you're going to lose money. Not really. You're going to be in the market. But what it gives you, again, I repeat myself, is a disciplined way to buy a good stock at a cheap price and get a discount. So look at the returns. Dogs of the Dow, 18%. Dow Jones Market, 14%. This is 2025. If you analyze it, even if you go over 10 years, almost the same thing. The dogs and the Dow are just basically beating the market. But what have you done here? You've given yourself some fundamentals. You've bought stocks on a fundamental note that are going to last you because they are blue chips and they pay you income. Like I said, if you don't like the trading, you want the income, this is basically going to be for you. So high dividend yield plus prices recovery, strong long-term returns. You are buying a good stock at a discount that is paying you a dividend. You can't go wrong with that strategy, guys. I don't see how you go wrong with that strategy. All right, and just to close out the theory part of it, right? Why are we doing this? Because we want to get fundamentals. I want you guys, when you are buying stocks tomorrow, you are thinking fundamentally. You're not buying stocks because you heard your friends say that stock is going to pay this, or you saw it on TV. You are being fundamentally driven. You are saying, number one, what's the payout? Because why are you an investor? To make returns. Your returns are two things: price appreciation and dividends. Price appreciation and dividends, right? It's easy to track price appreciation, but dividends are more, you have to wait for them, right? So those two things should guide you. If I want to buy a stock, I want to know what the price will do and what the dividends will do, right? So you are being more fundamentally driven. You are looking for companies that pay solid earnings and not just flash in the pan. You are looking for companies that will pay you sustainable dividends and not just to make money 1 year, they pay you and then they are gone. You are buying high quality companies when they are out of favor. That's what you're doing. You are buying rice when people are buying beans. Tomorrow people will come back and buy rice. You have already bought that rice. So it's a disciplined way to invest. There is no emotion. You are buying high yield stocks and mean revision, which means by next year, people are going to say, oh, wow, Verizon is very, very cheap. Let's go buy it. Then when they buy it, Verizon falls out of the NGX 30. See the point? When people realize that, listen, wow, Verizon is paying 6.9 dividends and the price has gone down, we're going to buy Verizon. The more people buy Verizon, the more its yield goes lower. So it falls out of the NGX 30. But the point is, it's making you more disciplined. It's making your decision process more disciplined. And you can't lose, because once you get this now, tomorrow when you want to buy, you're going to ask those questions. What's the dividend yield? What was the price 10 years ago? And that makes you a better investor, guys. That's the key thing for you. So guys, you can request to speak if you want to. We're just going to do this next 2 slides. Again, let me just show you how you're going to do it on Bamboo. Very, very important. So Bamboo, like just go on your Bamboo slide, right? There are US stocks, there's Nigerian stocks right there. US stocks, buy US companies, buy local companies. Pick that. Pick which one you want to build a DAO on. Separate them. You can build your DAO for US and earn US dividend return. And you can also pick your Nigerian stocks and then Naira return. Pick whatever stock you want to buy, right? Like I said, it's very, very easy. Go for the high yield stocks in a particular index, high quality index. That's basically what you want to do. Then just use the ticker. The ticker you found, use the ticker and you just look for the stock on Bamboo. So if for instance, let's go back. If you go back to say Nigeria, Access Bank's ticker is ACCSSCORP, Access Corp. That's their ticker. You just pick Access Corp and then you go straight back to the Bamboo app. Put the search NGX stocks or put search US stocks. Put it in there. It will give you the ticker. Always use the ticker. Don't buy with a name because some names might be the same. Like I always tell people, there's Fidelity in Nigeria. There's also Fidelity in the US. So always try to use the ticker. Just a way for you to just be more due diligence minded. So you always use the ticker. So you're buying the exact stock that you want to buy. And then, of course, you can then buy that stock and just build it out for yourself. Yeah, not a problem. That's my presentation, guys. Very, very short. I mean, like I said, it's a very, very simple thing to do. It's a way for you to become more disciplined in investing if you want to. So you want to basically do this and it will really, really help you. All right, guys. So I'm done. Let me just go real quick to my questions. So I have a question on YouTube. How about buying QQQ ETF? So QQQ ETF is already an ETF, right? You're already buying an ETF means it's a collection of those stocks already. And all that QQQ ETF is just the top tech stocks, right? Already in that ETF. It's like buying VIX ETF. You're already buying all the stocks. It's selected by market cap. It's not selected by dividend yield, right? So if you want to do dogs of the Dow, you can't just buy the QQQ ETF and it does the yield for you, because many stocks in the QQQ ETF don't pay a dividend. Tesla doesn't pay a dividend. Microsoft just started paying dividends just a few years ago. So you can't get the same effect as you would get if you just bought the VTI or the VOO, right? If you want to do something near to the ETF that we're talking about, you want to buy a dividend paying ETF like VYMA, or like those dividends that track dividend paying stocks. That's the nearest that you can do to get a dog to a Dow, because with the Dow you are targeting dividend stocks from blue chip. So while the QQQ, VOO, VTI are giving you blue chip stocks, many of those stocks in that index do not pay you a dividend. Hope that makes sense, right? All right, fantastic. So just an example, let me understand what this guy is saying. Yeah. So if you, and I get your question. So you are asking, where do you start from? Can you start now to do it? Yes, you can start now to build a dogs of the DAO strategy, because when you start now, you are saying you are buying the stocks if you see the data I put there as at May. I put May 2026. So as at May 2026, it has taken for me the companies in the NGX 30, sorry, not the NGX, the Dow Jones 30. It has taken those top stocks that have the highest dividend yield, which means their stocks have gone down. And it is basically telling me that these stocks are trading at a price discount. Remember, the discount is on the price, not on the earnings, on the price. So I'm buying a discounted stock on the price, right? And I'm also in line to get the discount, the dividend that they will pay in December or in August of 2026. So if you are buying today, you are going to buy the ND Dow Jones, the dogs of the Dow as at May 2026. If we do the same exercise in, say, April or in January, we might not get most of the stocks here. They might have changed, although I doubt that they will change that quickly. But it's tracking price movement in those highly capped stocks, right? I hope you understand the difference of what we're making here. So even if you want to buy now, it's just when are you buying? If you are buying, and you can go online and do this. You can go online and say, give me the dogs of the Dow 30. In a good site, it will give it to you. So again, most of these things are there for you. I think if you want to go through Bamboo, you can go in, do your filter to Dow Jones, and then select dividend yield. There's a way to do it there, but that might even be difficult for you. Just go online, do it, get the ticker, and you don't. The Dow Jones, the Dr. Dow says buy top 10. If you buy top 2, I won't kill you. You know, no one's going to arrest you if you buy the top 2, because you don't have the money to buy all top 10. If you buy the top 2, you are saying, okay, I'm modifying my own to buy the top 2. That's still something that you want to do. The idea is that for you to become disciplined, because you are buying the stocks in a way disciplined. That's what you want to do, right? Great. Let me see. So let me look under one. Would you say Access Bank? You said Access Bank has a higher dividend yield than Seplat. Yes, Access Bank has a higher dividend yield than Seplat because you are looking at the price of Access Bank compared to the dividend it's paying. So Seplat is paying you dollars. I get where you're going to your question. You are saying because Seplat is paying us more, why should a dividend? Yeah, because it's the yield, not the amount. You are comparing the dividend of Seplat to the yield of Access Bank. We are looking at the yield, which is the what you are paid divided by the price. So why Seplat is giving you more? It costs you more to buy Seplat, right? But with Access Bank, what's the price of Access Bank today? You can get a higher dividend yield because you are buying more Access Bank at a cheaper price than you would buy Seplat. Hope that makes sense. It's not dividend paid, it's dividend yield that we are looking at, not dividend paid, but dividend yield. That's what we are looking at, right? Are you saying that we can buy individual stocks? This is a question I'm reading, to build our DAO portfolio, or can we also get them grouped like the VOO? You can't buy the VOO to do this strategy. You have to buy your individual stocks. I will check if there's an ETF that tracks dogs of the DAO. I will check. But if you buy the VOO, you are already buying the top 500 stocks in America by market cap. Many of the stock companies in that index don't pay a dividend. Tesla does not pay a dividend, but it's going to be in the VOO, right? So if you buy the VOO, you can't do this because you're buying many companies that are not paying you a dividend. Make sense? So you've got to build your own. You can build, or if there's no, someone can check for me, there's no dividend that pays you, any ETF that pays you a dividend, then you really can't buy this one. You've got to build it individually, Paul. You've got to go ahead and build it. That's why I'm giving you the list. That's why I gave you a list for both Nigeria and both for the US. So if you're going to build a mixed portfolio, you can pick the top 2 from Nigeria, pick the top 2 from the US, and you've built yours out. Exactly. Does that make sense, Paul? So that's basically what you have to look for. Good companies, which means they're going to a very, very good index. Then high dividend yield, which means the price is coming down. Then companies that then pay you a good dividend yield. Make sense? So you have to build your own. So great question. I'm still reading the tweet. Have anyone speak on Twitter? What's going on with you guys? You guys are shy. Let me look at this question on this one. Yeah. Okay. Yeah, you guys asked the same question, so you have to read them to know which is new. Okay, can you explain? Let me go there. What the 18 years of increases for dividend history means? No, is that what you're saying? Yeah. So when the company, that's what they call dividend aristocrat. That's your question. What is it? Is it the same as dividend aristocrat? Not really. A dividend aristocrat is talking about a company, right, that pays dividends every year and also increases dividends. So when you hear a company say this company is a dividend aristocrat, that means every year, without fail, it will increase its dividends. Every year without fail. Either it's going to pay a dividend or it's going to increase its dividends every year without failing. So they call them dividend aristocrats because they increase their dividends every year, they go up, and they pay a return every year. Fine. But with the Dow strategy, we're not looking at the dividend aristocrats. We're looking at the price movement of those dividend aristocrats. So with the dividend aristocrat, they are paying dividends every year. So if you pursue that strategy, you are buying a company that is paying dividends every year. So you are pursuing an income strategy. But with this Dow strategy, talks about Dow strategy, you are pursuing a strategy that allows you to buy good companies at a discount. And how do you calculate the discount? The yield. So you are saying if the yield is going up, that means the price of the stock is going down if the dividends are the same. That's the key thing with this strategy and any other strategy. We are targeting falling prices and stable dividends. So it makes you very, 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 very disciplined. You're not just buying, but you're buying falling companies with stable dividends. You can't go wrong with that. There's nothing wrong with you buying a stable company and a falling dividend. So that makes sense to you, right? Fantastic. Can we talk about bonds? What do you want to talk about? We can do bonds next week, but what do you want to talk about? Bonds they are big money. So when we do bonds, we talk around money market. People buying bonds in Nigeria are basically buying money market, because if you want to trade bonds, that's a bit high end, right? If you're trading bonds, you need a lot of capital, number one, and it's a bit more technical than just buying equities. But I think the bulk of Nigerians that buy Nigerian bonds through money market, even though they're not supposed to, they're not money market, but they buy them through money market. And that's basically how they get exposure to that fixed income in Nigeria. So if you have a specific question on bonds, let me hear it, and I'll be glad to take them for you. But this is an interesting one again. What's this guy asking? This is not part of... So just to be clear, guys, I'm not asking you to go buy these companies. Now, I'm very, very clear. Let me put the companies again. So let's put the Nigerian companies. I'm not asking you to go buy Dangote Cement. I'm saying, right, that if you want to do the dogs or the Dow strategy, this is your current, for Nigerian edition, this is your current strategy or your current shares that meet the dogs or the Dow strategy in May 2026. If that's your objective, if you are an income chasing guy and you want to have a disciplined approach, this is what you're looking for. We're not comparing Access. We're not saying Access Bank shares are doing better than Zenith Bank shares. This is just looking at the dividend yield. But to your question, what this is telling you is this, that on a pricing level, on a pricing level, just price alone, Access Bank shares are cheaper than Zenith Bank shares. When we want to buy stocks, we don't look at the market price to determine if a cost is cheap or no. We look at the price to earnings. Price is a function of earnings. So if I'm going to buy a stock for 10 naira and that stock is going to pay me 10 naira, and I have to buy a stock for 100 naira and that company is going to pay me much more than 10 naira, which is cheaper, is the 100 naira stock. Because when I buy that stock at 100 naira, I get more earnings. So in the market, that stock that's 100 naira is taken as cheaper than the 10 naira stock. So when you look at Access and Zenith Bank, you can't say Zenith Bank Access is cheaper because the earnings or what you're going to get back from Access is higher than Zenith Bank. That's how you look at it. What will you get back? Which means if I put more money into Access Bank based on current earnings, I get more than if I buy Zenith, which means Access to me is cheaper. Hope that makes sense. So we're not ranking them according to which is cheaper. We're saying based on the dividend yield, this is what you're going to get. So if you were to invest in these companies, you get more for your money from Access than from Seplat. I think I explained that before. Seplat is just, I think you guys are confusing the what you are going to earn, or like what they are giving you in dividend, with the earnings yield. Don't confuse the earnings with the earnings yield. Don't confuse that. The yield is a function of the price, but what they just pay as a dividend, just dividend. So I get you, if you buy Seplat or Fidelity Bank, you get more naira, but what did it cost you to earn that dividend? That's what you're not taking into account, right? I'm surprised that question is getting a lot of you guys. So throw more light on the payout ratio and the role it plays when selecting a top 30. Yeah, the payout ratio is just how much the company is paying out from its earnings. You know, many companies will tell you we had a profit of 1 million naira or 1 billion naira, and we're going to pay you dividends of 100 million. That means the payout ratio is 10%, right? 10%. So do you want a company that's paying out 10%, or do you want a company that's going to pay out 20%? That's the whole idea. So payout ratio is how much of the company's net earnings is going back to you, even if it's gross earnings. How much of that company's earnings is coming back to you as an investor? As an investor, you want more to come to you. So if you have two companies that are almost the same, but one is giving you a higher payout ratio, you are more inclined to buy that one because you're going to get more for your money. So that's a good question. Let me answer it second, right? So when you're looking at payout ratio, then you are now saying, okay, I want to buy companies that are going to have a higher payout ratio than the others. They give me just a better return on my money, right? Do you understand what I'm saying? Okay, let me answer your question. Is very, very interesting. You are asking if a company is paying dividend and a company is not paying dividend, which is better? That's a great question, because many companies don't pay cash dividends, but they say they pay dividends because they buy back their shares. Or in Tesla's case, look at Tesla's argument. Elon Musk says, why should I give you a dividend when I can take that money and invest back into Tesla? And when I invest back into Tesla, the share price of Tesla goes up because investors see that I'm investing in Tesla and that in the future, Tesla's earnings are going to go up. So why should I give you the money? I'm a better manager of that return the company has made than you. And many investors agree. Unless you say you can allocate that capital better than Elon Musk. He's making a good point. Now, if you want cash, you can sell your Tesla shares, a bit of your Tesla shares, and get cash. But if the company makes $1 billion profit, Elon is saying I can invest that profit better than you. So allow me to keep that dividends in the company and invest it more. That's what he's saying. So is he wrong, or do we compare that with a company like, say, Philip Morris or Chevron that makes a lot of money and pays out of the dividend? It's a difficult question to answer, but let me give you the general rule. Companies that pay dividends are usually companies that are what we call mature companies. Because when you have a lot of cash, what does a company do? Its first instinct is not to pay out cash to investors. It's only in Nigeria where they give out cash, dividends to investors. Their first instinct is to invest that capital and grow. I give an example. In Nigeria today, as big as Dangote refinery is, I not hear him saying, I want to do detergents, I want to do polyethylene, I want to do ports, I want to do urea. Why? Because there's so much spare capacity in Nigeria that if Dangote invests $1 billion in Nigeria, he can make tons of returns. There's too much spare capacity. We don't have water, we don't have power, we don't have ports, we don't have roads, we don't have all this. So any dollar Dangote invests today, he makes a lot of returns back because there's a lot of market, a lot of capacity. If you take Dangote to America, he can't make that kind of money. What will he do? Will he build a new port in Texas? Okay, what will happen? They have ports in Texas. Will he build a power plant in Louisiana? They have power plants in Louisiana. What will he do? Will he build a new petrochemical plant in Texas? They've got that already. So you see the point I'm making. So the scale at which you can, when you have money, if there's lots of opportunities to invest, then you don't pay dividends. You keep the dividends in your company, then you invest. Tesla is in EVs. It's not an internal combustion engine. So there's a lot of capacity for him to invest the money in building battery factories, gigafactories, in building plants in China and Berlin, than giving you the money. But Ford Motor Company, what else are they going to build? They have many factories all across the world. They're even in Nigeria, right? So where are they going to invest the money in, really, that's going to make a difference that will change the share price? So they can afford to give you a dividend. Same thing with Chevron. Chevron is going to be, they're making money from oil. What else will they do? Will they go and build cashew plants? No. They drill oil, they make oil, they sell oil, they give you dividends. Nothing else they're going to do. They can do it better and more efficiently, but that can't cost them the total profits they make. So they have to give you dividends. So when you see a dividend paying company, it's usually a very, very mature company that has no other capacity to invest in. Then it gives it to you. Look at cigarette companies, Philip Morris. If you want to make a lot of dividend income, you want to buy Philip Morris. They pay a lot of dividends, huge amount of dividends, but they sell cigarettes. Why? Because they can't invest anywhere else. It's hard to open up a cigarette plant in America today. So all the profits they make, they pay it out, most of it. Same thing with REITs, they pay it out. So if you say which is better, it's not really which is better, it's what is the company doing. If the company is in a mature industry, is in utilities, is in maybe a regulated industry, they tend to pay a lot of dividends. But if it's in a fast-growing economy, if it's an Alphabet, an Apple, a Tesla, a Meta, they don't pay dividends out because they can take that money, reinvest it for you, and make a lot of profits for you. Yeah? All right, fantastic. So you want us to talk about money markets and bond ETFs, depth of bonds. Okay, yeah, we'll do a space, Richard. We'll do a space on money market, bond ETFs, and we'll bring it over to you guys maybe next week. Next week, I'll do something different. Maybe something to do with property. I'll do something like that. And then that'll also be interesting. And then we'll bring it to you guys. All right, folks, let me just take a few. I don't see anyone in Twitter asking to speak. I wonder what's going on. But let's take a few questions on with Twitter. You guys ask the same question. I have to read them to get a really nice one that you guys haven't asked, but you guys sort of repeat yourselves. Not that you're repeating yourself, but the question you've asked, someone has asked it before, and I just want to make sure I am not. Look for a good one. Yeah, so yeah, I answered this question on, we're not comparing Zenith, we're comparing the yield, not the dividend. We're comparing the yield, not the dividends. Key clarification. And I've also said to you that you are looking at the return, not the return the company is giving you, but the yield of that return, which means you are comparing it to the price you bought. That gives you yield, not just, yeah? Okay, so but good question. Yeah, so if you look at, this is May 2026. Again, I've done this chart for May 2026. You have to make sure you do yours for the time you want to invest. So if you're going to build, keep in mind this company's prices go up and down, but dividends are issued at specific times. So the price can go up and down, but dividends are at regular intervals. So when you are buying, keep that in mind. If you do this table near dividend time, it will change a bit, right? Because dividend is going to be the dividend vis-a-vis the rest. Yeah. Okay. So keep in mind. Okay. What else? Yeah. Fantastic. Let me see. I've got a guy here, brave guy on Twitter that finally wants to speak. I was wondering why you guys were being shy. GLDN is connect. GLDN, what's happening, man?
Oh, hi. Good evening, Mr. Kalu.
Hey, what's up?
I'm very well. Firstly, I want to thank you for this opportunity. It's my very first time joining your space. I mean, I follow you on the timeline. I'm a big fan of your work.
Thank you, sir.
But this is my very first time joining your space. So I have a few questions, but the very first one is, so when looking at stocks to purchase, so is it enough to just go for those with the highest dividend yield? Like, what are the metrics to look out for when trying to get a good stock to purchase? Not just an ETF, because you want one paying dividends. And like you mentioned, most of these ETFs have companies that don't pay dividends. So what are some of the metrics that determine a good stock?
Great question. Excellent question. I would say you have to go with your objective, right? So let's assume I am a 30-year-old guy and I want to buy shares because I want to retire when I'm 60. So I want to invest for 30 years and I don't have a lot of money. So I want my investments to grow for me so that in 30 years time, I have millions, but today I have thousands. So my objective is what I call capital appreciation. You see, capital appreciation. I'm looking for stocks that have the ability to grow times 100. So I'm looking for those companies that the price earnings are a bit higher. The PE is a bit higher. The price earnings is a bit higher. I'm looking for companies that have a lot of earnings. They don't have to pay dividends today, but have a lot of earnings, right? I'm looking for companies that they are in a market that market is growing. The market is growing and their share in that market is growing. So I'll give you a good example to explain that. I'm looking for a company that is doing AI. That's what I'm looking for, an AI company that is growing its share in AI. Because AI is growing, the company in AI is also growing. I don't want dividends. I want to be in that company so to rise. I don't want a company that is doing typewriters, but it's growing in a market of typewriters. You see what I mean, Jelody? I want to get a company that if I give them my money, they're going to take my money, reinvest it in 10 years. I don't care about dividends, but in 20 years, wow, that company has gone from my 100 Naira to my 100K. You see where I'm going to with this? Because I am interested in capital appreciation. I'm 30 years old. I want to retire when I'm 60. I don't want dividends today. You see? So that's what I'll look for. Earnings. Share of the market. Is that market growing? What else? I'm not interested in cash flow. I want a company that can grow fast. But if I'm a 55-year-old guy, I'm married, I have kids, I'm going to retire when I'm 60, what companies will I look for and what indices will I look for? Oh, now I'm interested in a company with a very, very high payout ratio. Their dividend yield is very, very high. Their return on equity is very, very high. Return on capital is very, very high, right? I'm looking for a company that has got a mature, steady management. I want them to have a high payout ratio. So in fact, if you go to Warren Buffett and you type Warren Buffett criteria, you see high return on equity, low debt, high earnings per share. That's what I'm interested in today. So your answer is, who are you? It depends on why you are investing. If you know why you are investing, you are either going to chase a growth stock or a value stock. Growth or value. Dogs of the Dow work for value investors, not growth investors. Value investors, not growth. So if you just go online and say, tell me about growth investors, it will tell you what criteria you should use to look for growth stocks. Simply take that growth stock criteria, ask your computer, give me the top 5 growth companies in America or Nigeria. It will give you. You see how the AI is making our job easier. In the past, I would tell you calculate this or calculate that. I'm not going to lie to you, my brother. Just go online. Say, I'm in Nigeria. I'm 35 years old. This is my income I make. I want to grow. I want growth companies that can grow by 10x or 15x. Give me a list. It will give it to you. Then when you get that list, you can ask me, is this company really good for a growth company? Then we can debate it. You see what I'm saying? Because you invest according to your objectives. You don't invest according to returns. So what you want might not be what I want, GLL, GLDL. Does that make sense? GL? I can't hear you, sir. GLDL is off, but that was a fantastic question you asked. So again, guys, there are some metrics that are just that you have to look out for. If you want to agree the metrics, return on invested capital, ROIC, return on invested capital. Look at that return. It should be high. Price to earnings ratio, if preferably, it should be low. Cash flow generated, preferably should be high. Return on equities, return on assets, preferably should be high. Debt to equity, preferably should be low. These are metrics that are for performance, for efficiency ratios. You want these metrics to be the same across the board. But the point I'm making to you is that if you want a fast-growing company, those metrics they're not going to use those same metrics for like a mature company. So if you look at an AI company, if you look at what's their name? What's a good AI company? ChatGPT. They are making a lot of losses today. They have very, very low return on invested capital. But would you buy those stocks? Yes. Because you want to basically get into those stocks. They're in a fast-growing sector and they're the market leader in that fast-growing sector. So you are buying them for tomorrow, which means they are growth companies. If you use those metrics that I've just talked about for value, for growth, they will fail. Same way if you use growth metrics for a value company, they will also fail. So the answer is buy the company, know the company before you buy. Is it a growth company? Then use growth metrics. Is it a value company? Then use value metrics. You can't mix both of them. Give you a good example. Amazon, for many years was making losses, but they were generating billions in cash. They will take the cash, reinvest to grow the business. If you go to Amazon, would you say Amazon was a growth company or was a value company? Difficult to tell at that time, right? But if you say, okay, the company must make a profit, they were making a loss. If you say they must have a low debt, well, they had low debt, but they were growing. So you want to ask yourself, what is my intent when I look at Amazon, and what do I want to buy that stock for? Am I buying that stock because I'm interested in them in future paying me a dividend, making a profit like they are today? That's what you'd have said 10 years ago. They would have bought Amazon stock 10 years ago because you know eventually the company will turn around and then make a profit. But again, you can't just say because the company is making a loss, I'll keep on investing in the company. Uber has been making a loss forever and ever. I don't think Uber is set up to make a profit. They have a lot of market reach, a lot of people use them, but because their costs are just so high, they have a high acquisition cost. They can make a profit in 1 year, but it's very, very difficult to sustain that profit. So you might see Uber eventually get bought up by another company that will use them to grow their own side of business. Because when you tap, what's Uber's massive advantage? They know they have data. You use Uber can tell you where people go to work, where people go to eat, where people go for entertainment. Uber has that data. And content and data is more valuable than profits. So imagine if ChatGPT buys Uber. Now they get access to where people are going to at what time, what shop people are going to. Same what you eat. What are people buying to eat? Imagine Uber now knows, or ChatGPT now knows how many people buy pizzas in Ikeja, how many people buy Eba in Yaba. So if you then you are making pizzas and you tell ChatGPT, where should I sell pizzas? Boom, they can tell you. So data, content, those are key things more than even profit. Profits are, as I say now, I wrote an article a long time ago, is invest in debt because no one cares about profits. There was a company called Hertz Rental. making a loss, they did an IPO, put on the IPO, this company is not making a profit. If you invest in this company, you can lose your money. And people also invested. In America, not in America, also invested. So GLLD, that's your answer. Long answer, but I try to give you as much as I can give. Right? I hope you do you have a comeback? GLLD. I can't hear you when you're speaking. If you can hear me. Okay, fantastic. So someone's asking me, can I rewatch this video? Yes, you can rewatch this video. It's going to be on YouTube. We also have the podcast recording as well. So if you go to the YouTube, it's going to be recorded. You can rewatch it there, or you can also listen to it on the podcast, and it's going to be there as well, right? So, and we also have, if you do the podcast, it's The Way I See It. It's available on YouTube, on Apple, Spotify, on all major podcast channels. You can find The Way I See It, and it's going to be there, so you can listen to it at your convenience. I make sure I do the pictures so that way you can go back and watch the videos, take your time, freeze frame, and listen to what we're saying, because it's just fantastic information out there. So again, guys, we're going to wind down now. I just want to thank you guys for listening in. Just want to thank also our sponsors, Bamboo App, for being a great sponsor and for allowing us to bring this to you. Nothing is free, guys. Someone is paying to make sure you guys get this information, because you guys, this is the way you invest. Anyone can tell you I can invest. What is important is that you have your strategy. If you don't have a strategy, imagine if you go play soccer. Imagine if you just said, I'm going to play Champions League finals, and whatever we see there, that's how we'll play, right? People will say you are mad. You have to have a strategy. If they're attacking, I defend in depth. If we cannot do counter attack, I'm going to get my wingers to run very, very fast. It's the same with investing. How old are you? What is your attitude to risk? How much do you have today? Where would you want your money? These are the same questions you've got to ask yourself. And when you answer those questions, that's how you invest. If you are younger, then a stock like Seplat looks different to you than to an older person. It's the same stock, but it looks different to you than if you are younger. So you got to ask yourself, we're all not the same. You have to invest according to your objectives, right? If you don't want dividends, don't do this. And there's nothing wrong with that. If you want just to grow, then you should be looking at the stocks outside the Dow, outside the NGX 30. If you want to do that in America, that's going to be the Russell. In Nigeria, that's going to be all stocks outside the NGX 30. That will give you growth, but has a higher volatility. NGX 30 will give you growth and value with lower volatility. So it's not the same, right, for everyone. Fantastic, guys. All right, folks, let me let you guys go enjoy the rest of your day. We'll be here next week, like I said, and we'll have a great topic. We already have a topic here. One guy Richard wants us to talk about bonds, money market, and ETF. Yes, we'll do that. I know we've done an ETF, Richard, where I spoke around bonds. I built portfolios for 30-year-old kids and for 60-year-old retirees. Go look for it. I focus also on equity-only ETFs, and I also focused on fixed income ETFs in Nigeria. I give you the ETFs, I give you mutual funds for that. So if you can find that, you can look at it. Can we talk around financial statements? Sir Comage, what do you want to talk about? How to understand them? Of course we can. Just send me your invitation and I'll sort of craft it and I will come talk to you. Ooh, I got Julius. Julius, real quick. What's up, Julius? Let me get Julian. Julian. Oh, Julian. Julian, hi, what's up? Now they all want to talk. Julian, what's up? You got the mic. Let's do Chi. Chi Mili. Chai Mili. Is it Chai or Chi? Chai Mili. No, it's Chichi. Chichi, how you doing? What's up? I can't hear you guys. Is there a problem? I can't hear anybody. Let me see. Chai, are you speaking or is it Julian who is speaking? I can't hear you guys. Well, I have to call the day. I can't hear you guys. Maybe there's something wrong with Twitter today. Usually I get lots of folks to speak. All right, we'll call that. All right, guys, you guys take good care. Again, guys, remember, I've got a book, Let's Talk About Your Money. That's my book. It's available on Amazon. It's fantastic, even though I say that myself. Get the book, give it as a gift. Most of the stuff you see here on that I talk about, it's in my book, right? I talk about very, very simple ways that you can invest, principles. Nigeria, the US, I've got tons of experience and I put them all out in the book. You can get that book, you can read it. It's not a cover to cover book, it's a chapter by chapter book, which means you can just pick a specific chapter and you can read that chapter and you can learn all you can about that specific thing, like maybe investing or bonds. I use Nigerian examples. I give you the real examples, this asset class, this one and that one. So try to get it. I think it will bless you a lot and you understand most of the stuff that I say here. So on that note, guys, let me let you guys go. I'll talk to you guys next week. Yes, you can send me a DM, not a problem. Have a good one and bye, guys. I'll see you guys next week. Take care and bye. My name is Carlo Ajay. There was something to say that at the very end. Thank you so much, guys. Bye.